Good evening, everyone. Hope you all are doing well. So, today we are going to discuss past papers of quality management, which is ISQM-1, ISQM-2, and ISA-220 revised. Previously, it was quality control, but now it is quality management. So, there are few past papers questions in which you will find quality control, but from now onwards whenever you are going to solve the questions on quality management, you will have to write the word quality management instead of quality control. Now it is system of quality management, SOQM. If you have not watched my lecture on ISQM 1, 2 and ISA 220, then I would highly recommend you to go and watch that lecture on my YouTube channel ACCA Passpoint, because if you have not watched that lecture on ISQM 1, 2 and ISA 220, then you would not get the things which I will going to discuss in this past paper lecture. Also, if any student failed at 40, 45 or 48, 49, it means you are lacking in your practice, means you have not done past papers, or you don't know how to solve the past paper questions, drafting techniques, linking techniques, and the professional marks. Because in AAA there are 20 out of 100, 20 marks are professional marks, which is easy to grab if you know the techniques. In my past paper series, I have discussed all these techniques. Now solve this question. Also, one more thing, if you are that student who always prefers selective study, then trust me, this exam will not be passed if you are a selective study student. Otherwise, this exam will again call you for the next attempt. That's why I would highly recommend you to watch all the topic. There is no point to ignore any particular topic and move on. It's my humble request to at least try to watch all the previous lectures on block 1, block 2, and block 3, then block 4. If you go sequence wise, then it would be helpful for you. Also, the block 2 has its own significance importance in your exam. There is no exam sittings in which there was no question from the block 2 ethics, professional issues, and quality management issues. That's why block 2 and block 3 are very, very important for your AAA exam. If you will not cover these two blocks, then there is a possibility you will not pass in the next exam sitting. If your attitude will continue to be same in the future attempt, then again you may not pass in that specific attempts as well. Let's start. These are the few past papers questions which have been tested on this topic till now. There are other questions which we have done in the yesterday lecture, which was ethics. Now, Forsythia Group. This is one of the most important and complex question till now on this topic. First, read the requirement. Requirement: evaluate the quality management and other professional matters identified during your review in respect of the planning and performance of the Forsythia Group audit, and recommend appropriate actions to be taken. Now, I have mentioned so many times, whenever the examiner asks evaluate, evaluate means you have to give your conclusion. Now, let's see. In this lecture, I will be little bit more fast because there are so many questions and the length of these solutions are quite more. That's why I have to be little bit fast. The audit of Forsythia Group, the group for the year ended 31st March 2005, is in the completion stage and the auditor's report is due to be issued next week, means audit is almost completed. The group has diverse operation, means multiple operation, different places, focusing on manufacturing, but is also involved with activities in some other areas such as agriculture. Whenever there is about agriculture, highlight this word because it is specialized industry. If you have not covered my lecture on block 1, then you will not know about the specific industries. There is a separate technical article on specific industries. Sorry. The draft consolidated financial statement include revenue $129 million, profit before tax $118.6 million, and total assets $465 million. Whenever there are profit, total assets or revenue, this is for the materiality calculation. Now, you have discussed the group audit with a junior member of the audit team who made the following comments about how it was planned and carried out. On 10th June 2005, the group acquired another subsidiary, Robin Company, which is forecast to increase the group's total revenue by around 20%. Highlight this thing because it will help us to identify whether the subsidiaries are significant or not. If you have not covered my lecture of block 1 on using the work of other, then you will not get the concept of significant subsidiary and its relevance. This means that the group chief finance officer CFO had little time to discuss matters with the audit team. Highlight this thing. Little time means pressure on the audit team. The acquisition has taken place quickly and so did not form part of the audit planning, which took place in January 2000 X5. Okay. How is it possible that if anything is acquired is not reported or communicated to the audit team? This is a serious issue. The audit engagement partner said that we did not need to perform. This is a vague response by such an authentic and a reliable person. Audit engagement partner can't say this thing. The examiner gives you this thing because the question is about the evaluate the quality of the audit at the planning and performance stage. That's why the examiner gives you such vague responses on any aspect of the acquisition, as according to the CFO it will all be accounted for in the next year financial statement. It will be accounted for in the next financial statement, but we have to give a disclosure this year because it is non-adjusting event and which is a significant event. Now, due to pressure to reduce the cost of the audit manager arranged for the audit procedures on revenue recognized by several significant subsidiaries, including a subsidiary in the agricultural industry to be delegated to Camellia Associates, an unconnected firm. The audit manager said that we can rely on the evidence obtained by Camellia Associates as they are firm of qualified accountant. This is again invalid response. If a subsidiary is a significant subsidiary, then we studied as a parent auditor, as a group auditor, we have to check the prerequisite criteria, ICED. So the audit manager statement that we can rely on the evidence obtained by the Camellia Associate is invalid. We have to check the prerequisite criteria and then we will have to evaluate the work performed by the Camellia Associates. Okay. I also audited the group's intangible assets, which involved evaluating the assumptions relating to the appropriateness of capitalization of 1.2 million of development cost in the year. I couldn't discuss this with the CFO and no one else was available, so I agreed the assumptions, for example, relating to the technical feasibility and commercial viability to the group's business plan and concluded that they were consistent. Again, this is not a valid justification, means you can't compare. Also, if you are a junior, this is the first year that development costs have been recognized as an intangible asset. This is the first time. Of course, there are some R&D as well. Asset in the group financial statement. You company which operates in the agricultural industry. Now, from here to there, this is all about the specialized industry. If you have not covered my lecture on this particular topic in which I have discussed the specialized industry technical articles, so you will not able to understand this one. Is a subsidiary of the group at the audit planning stage in line with the previous year's audit. It was not identified as a significant component. However, due to the specialist nature of the operations of the company, consultants should have been used to provide input on some technical matters. As stated in the audit strategy and audit plan, due to cost implications, the consultant was not engaged, and the section of the audit strategy and audit plan containing instructions relating to the consultant was deleted from the audit files. Highlight this thing as well. Following your conversation with the audit assistant, you reviewed the audit working papers and found the following. The audit evidence obtained by Camellia Associates has not been reviewed by the audit manager or partner. Such a big invalid statement means this is not possible. How is it possible that no, even not the audit manager or the partner will review the evidence? No further evidence has been obtained relating to the development expenditure. Again, invalid. We have to obtain the breakup of the expenditure. U company has total assets of 60.5 million and revenue at 6.5 million. Now, solve quality management and professional matters. Your heading, then matter number one. New subsidiary Robin Company. On 10th January 2005, the group acquired another subsidiary, Robin Company, which is forecast to increase the group's total revenue by around 20%. This is a significant subsidiary, increasing the group revenue by 20%, means it increases the threshold of 15%. Now, however, this subsidiary was acquired after the year and it should be disclosed in notes to the financial statement, as it is a significant non-adjusting event for which conditions didn't exist at year end. Now, this means that the group chief finance officer CFO had little time to discuss matters with the audit team is not justifiable, as it is against the requirement of IAS 10 events after reporting date. If you want to watch this lecture, then you can watch IAS 10 lecture on the SBR playlist, which shows that the chief executive officer, being the senior person, is not competent enough. Furthermore, this casts doubt on the integrity of the CEO. To hide means conceal such information from the audit team. It means CFO wants to hide this thing from the audit team. Why? Because this is such a significant information, so they don't want to disclose to the general public. The acquisition that took place quickly is not a valid justification for the disclosure should be mentioned. Means there should be a disclosure for this non-adjusting event. The audit engagement partner said that we didn't need to perform audit work or any aspect of the acquisition, as according to the CFO, it will all be accounted for in the next year's financial statement. This shows that the engagement partner and CEO have no relationship, which can result in a this shows that the engagement partner and CEO have a relationship. You have to write have a relationship which can result in a familiarity threat and cast doubt on the integrity of the engagement partner, as the partner refuses to perform any work. The engagement partner should maintain professional skepticism and be independent of the Forsythia Group members. This further shows the lack of competence and leadership skills of the engagement partner. Matter number two, Camellia Associates. Media Associates. Procedures on revenue recognized by several significant subsidiaries, including a subsidiary in the agriculture subsidiary delegated to the Camellia Associates and unconnected firm. This is not a valid approach, as a significant subsidiary should be audited by the group auditor or any of its component auditors after checking the criteria of ICAEW. However, the pressure to reduce the cost of the audit indicates that there is an intimidation threat by the management, due to which the scope of the audit team might be affected, and procedures in other areas may also be performed less, which is against the preconditions of the audit. Lecture number 1 on block 2. Also, revenue is a significant component of the financial statement. It should be audited by Mongolia and Company, and any of its component audit teams. However, procedures on revenue performed by Camellia Associates increase risk of material misstatement. Why? As Camellia is an unconnected audit firm. It is not a member firm of our audit firm. Also, it is not a component auditor of our firm. Also, it does not have any international affiliation as well and might not have a specialization in the agricultural sector. The audit manager said that we can rely on the evidence obtained by Camellia Associates as they are a firm of qualified accountants is not justifiable. Only qualified accountants are not competent enough to perform the audit of a specialized industry. Also, the engagement partner's comment shows a lack of integrity and competence skills that he agrees to rely on the work of Camellia Associates without performing any procedures. Look, for the one heading, I have written so many points. This is how you will have to write. The group audit team should evaluate the independence, competence, and experience of the Camellia Associates before placing any reliance on the work performed by the Camellia Associates. Also, the group audit team should ensure that the Camellia Associates have performed proper risk assessment at the planning stage of procedures and obtained sufficient appropriate audit evidence. However, if possible, to extend the deadline of the signing of the audit report. Further procedure should be performed on revenue recognition to ensure that revenue has been recorded appropriately. You can also write that for in order to extend the deadline, permission from TCWG should have to be obtained. Intangible assets. The amount of the intangible assets capitalizing 1.2 million is material to the profit before tax, that is 0.93 million, and revenue 0.645 million, but immaterial to the total assets 4.65 million. Therefore, based on the higher materiality, it is immaterial as it is below the amount of materiality calculated based on total assets. As per IAS 38, internally generated intangible assets should only be recognized if they meet the condition of probable chances of economic benefit, intention to complete pirate criteria. Remember the criteria pirate. If not, you can watch my lecture on intangible assets as well. Sorry. Technical feasibility, economically viable. As the junior team member only agrees, the two assumptions with the group business plans are not valid. Even if the CFO and other team members were not available, still audit team members should hold this misstatement. Look how you copy the point from the question, then explain into your words. Do not use general terms. Use the ISA specific terms such as misstatement, as assumptions are estimates that involve subjectivity and a high risk of management bias, means manipulation, massaging the figure. Therefore, it should be dealt with skeptically, means professional skepticism should be high. Also, this is the first year that development costs have been recognized as an intangible asset in the group's financial statement. Proper assumptions should be reviewed by the audit team to ensure whether it meets recognition criteria or not. However, if the criteria are not met, then it will result in an overstatement of assets and an understatement of expenses. For you, at the planning stage, in line with the previous year's audit, it was not identified as a significant component is incorrect. Why? Because the specialist nature in subsidiary is also a significant component. Look how previous topic lectures are linked with the past papers, as the audit team might not have sufficient knowledge relating to such a specialized nature of operations. Therefore, consultants should be hired for the technical matters. Not engaging the consultant due to cost implications is not a justifiable reason as it increases the risk. This these are all the matters. Now at the end you have to give a conclusion. Your matters can be different from mine, but make sure you cover the complete marking scheme. Planning and performance of the Forsythia Group have encountered several quality management issues which have been discussed above. Such issues should be adjusted before the signing of the audit report next week. Also, if possible, further procedures should be performed in the areas above mentioned after obtaining permission from TCWG regarding the extension of the signing of the audit report. Now, question number 5, CO per group. In some of your exam settings, the examiner asks you a general question, means theory-based question on this topic as well. So you just have to root, learn, or memorize. Discuss the quality management procedures. Now it's about quality management, which should be carried out by Rockwell and Company prior to the audit report on the Hopper Group being issued. So following are the quality management procedure that should be performed by Rockwell Company before the issuance of an audit report. A review of the audit working papers. There should be proper consultation between the engagement partner and the engagement manager. Furthermore, there should be consultation between the engagement partner and TCWG with an independent partner regarding the second opinion. An independent engagement quality should be performed by an independent engagement partner or manager on the work to ensure that the engagement is performed appropriately under the adhered policies and procedures of Rockwell and Company. Now, Bradley Company. Read the requirement. Explain the quality management and other professional issues raised by the audit seniors commit in relation to the completion of the audit. The audit of Bradley Company's financial statement for the year ended 31st August 2014 is nearly complete, and the audit report is due to be issued next week. Bradley Company operates steel processing plants at 20 locations and sells it to manufacturers and engineering companies. You are performing an engagement quality management review on the audit of Bradley Company. As it is a significant new client, highlight this one significant new client of your firm. The financial statement recognized revenue of 2.5 million and total assets of 35 million. Part A. The audit senior who has been working on the audit of Bradley Company made the following comment when discussing the completion of the audit with you. We reviewed the final version of the financial statements and the chairman's statement to be published with the financial statements yesterday. Now, I have quickly looked at the financial statement, but the audit manager said I need not perform a detailed review on the financial statement as the audit was relatively vague response affects the quality. The manager also said that he had discussed the chairman's statement with the finance director, so no further work on it is needed. Chairman's review report, director's report is not in our scope as we are not responsible to express an opinion on these reports as we are only responsible to express an opinion on the financial statement which comprise five components: statement of financial position, statement of profit and loss, other comprehensive income, statement of changes in equity, statement of cash flows, notes to the financial statement. Out of these five components, if there is any report or any document mentioned, we are not responsible to believe or express opinion on that. Now, answer quick look. Your heading can be different. The senior had a quick look at the final version of the financial statement. This must have resulted into ignorance of many misstatements within the financial statement because a quick look means just an overview, means the review was carried in a rush. Now, no detailed review. The manager has given a wrong instruction to the senior, instructing him not to perform detailed review of financial statement. This is a breach of relevant audit framework under which performing detailed review of financial statement at completion stage is mandatory. And in this case, it was much important being a new audit client. Low risk. The manager exercised a wrong judgment as he considered the audit to be low risk despite the fact it was the first year audit of Bradley's financial statement. First year audit can't be low risk as auditor has less knowledge of business, making first year audit high risk engagement. In case of first year audit, there is a deduction risk because we have no information about the client, so we are not knowledgeable whether the last year closing balance, which become this year opening balances, are correctly brought forward or not. So again, we have to check the opening balances as well in case of first year of client. Now, Davis Company. Why I have chose this question? Because this question is linked with your block 3 knowledge as well, reporting knowledge as well. Look how previous block knowledge integrated with your next block questions. If you have not covered or watched the previous block lectures, then you may face difficulty. Even though I tried my best to cover each and everything in specific detail, but again, we as a human can be forget about such things. So pardon if you are facing any difficulties. So evaluate the audit management issues and the implications. Whenever there is a word implication, it means the impact on the audit report or the audit opinion or on the audit. For the completion of the audit, including any further actions which should be taken by your audit firm, your answer should include the matters to be communicated to management and to TCWG in relation to the audit of Davis Company. Now, Davis Company. The audit of Davis Company's financial statement for the year ended 30th November 2017 is nearing completion. All audit in these questions are at completion stage. Wow. And the auditor's report is due to be signed next week. Davis Company manufactures parts and components for the aviation industry. You are conducting an engagement quality review on the audit of Davis Company, which is a listed company. Highlight this one as it is a listed entity and a significant new client. Oh, listed and a significant new client of your firm. The financial statements recognize revenue of $8.7 million, assets of 15.2 million, and PBT 1.8 million. You have identified the following issues as a result of your review. Now, issue number one, the planned audit approach to trade payables was to place reliance on purchasing controls and keep substantive tests to a minimum. Means they perform control and they perform less TOD. During control testing on payables from a random statistical sampling, the audit team identified 3 purchase orders which had not been authorized by the procurement manager. Means there is no authorization, no signature, no approval. On review of the supporting documents such as GRN, the audit team concluded that the items were legitimate business purchases and therefore concluded that no additional procedures were required. Let's solve this part 1. Control testing on payables. The absence of evidence of authorization by the procurement manager in relation to the 3 purchase orders represents an exception to the effective operation of an internal control on which the auditor intends to place reliance. The review of the supporting documentation and the conclusion that the items were legitimate business expenditure do not resolve the exception in the effective operation of the control. There is a risk that other exceptions and further unauthorized purchases may have occurred which may not have been for legitimate business purpose. Means fake or duplicate invoices, duplicate supplier invoices. The audit procedures therefore appear to have been inadequate. Look, most of the questions are similar, but there is a slight change of the wording. In this question, examiner used the word legitimate business purposes, and in the previous question, they used the word fake or dummy invoices. The audit assistant should have reported the matter to the manager and partner for them to decide if further work or risk analysis was required and who it should be reported to. To those charged with governance, this should have also been picked up during the review of the working papers. Prior to finalizing the audit, the audit team needs to assess the extent and significance of the internal control deficiency and should consider increasing the original sample size and extending the audit testing. Means you should have also performed TOD, test of details. If the extended testing identifies further exceptions in the effective operation of the control, the auditor should review whether a controls-based approach is appropriate and consider whether more substantive testing on payables component is required. The auditor should also consider including the matter in the report to the management. The auditor is required to communicate significant findings from the audit to those charged with governance. These include significant difficulties encountered during the audit and any extensive unexpected effort required to obtain SAAE. The absence of authorization by the procurement manager in relation to the three purchase order. Remember, the three purchase orders requires extended audit testing and represents a potentially significant deficiency in the operation of control. This is how you respond or communicate with the TCWG, as it mentioned in the question requirement that you have to communicate, respond to the management as well as TCWG. It therefore represents a potentially significant audit finding which should be communicated to those charged with governance. So that's it for part one. Now there are three other parts which I would like you to solve. Even though I have written down their answer as well, let me show you. Let's see. For part two, petty cash fraud. Part three, cut off testing on revenue, and part four, tax advice. So try to solve these questions, then compare with these. If you are 40-50%, your answer are matching, then you are on a right track. If not, then you can discuss with me. I would highly recommend or highly advise you to comment down if you have any issues, because if you do not comment down the video about your issue, then how can I improve myself and how can I try to communicate with you? Because there is no point if you just watch this lecture and go on watching them, go on watching them, go on. That's why there should be a two-way communication. If you want me to be sincere with you and want you to be sincere with yourself, then you should make a two-way communication, as communication is very essential. Now, Stanley Company. Even though I have discussed these questions in our AAA lecture series on the topic of ISQM-1, which is lecture 3, but again I have write down their answer as well for your better practice. So if you want an interpretation or discussion on this question, then you have to watch that lecture. But for the answer, you can refer this lecture or this file. Now, after that, we have a Watson company, which is a new question which I am going to discuss with you. Comment on the quality of the planning and performance of the audit of Watson Company, discussing the quality management and other professional issues raised. Let's read. One of your colleagues at Jensen and Company, Rodney Evans, has been taken ill at short notice and you have been temporarily assigned. Highlight your temporarily assigned. We have done so many questions on this keyword yesterday. Temporarily assigned as audit manager on Watson Company, an IT consultancy company, which is listed on a second tier investment market. The final audit of Watson Company for the year ended 30th June 2008 is approaching completion, and you are in the process of reviewing the audit working papers. The draft financial statement for the year recognized PBT 54.2 and total assets 23.1 billion. These figures are for the materiality. The audit supervisor, who is a part qualified chartered certified accountant ACCA, has sent you an email from which the following extract is taken. Let's read. It's great to have you on board, as I was beginning to worry that there would be no manager review of our working papers prior to the final audit clearance meeting next week. Highlight this thing. The audit assistant and myself have done our best to complete all of the audit work, but we only saw Rodney on the first day of the audit about a month ago when I think he was already feeling unwell. We had a short briefing meeting with him at which he told us if in doubt, follow last year's working paper. If you are facing difficulty, just refer the last year working paper. How could a manager say this thing to their juniors? One issue which I wanted, but let me tell you, even in practical life, most of the managers or senior supervisors suggest this thing to their juniors. Refer last year working paper. One issue which I wanted to check with you is that Watson Company has introduced a cash settled share based payment, IFRS 2 share based payment. You can also refer my lecture on IFRS 2 share based payment under the SBR list. By granting its director share appreciation rights, SAR share appreciation rights. For the first time this year, this was not identified at planning as a high risk area. The SAR were granted on 1st July 2007, at which date the client obtained a valuation of the rights which was performed by an external firm of valuers. I have filed a copy of the valuation report and I have looked up the valuers online and found a very professional looking website which confirms that they know what they are doing. The cost of the SAR, it's a share appreciation, right? Okay. Scheme based on this valuation is being appropriately recognized over the 3 year vesting period. So there is a vesting condition, which is 3 year vesting period means you have to be in that company for the 3 year, and a straight line expense of 195 has been recognized in the SOPL. A corresponding equity reserve has also been correctly recognized on the SOFP. The amount also seems immaterial, and I can't see any need to propose any amendments to the financial statement in relation to either the amounts recognized or the disclosures made in the notes to the financial statement. Now let's solve. Quality and professional issues, team composition. The audit team assigned to the audit of Watson, a second tier listed company, seems inadequate. Why? As it just has two staff members, yes, audit assistant and the supervisor who is a part ACCA. The part qualified audit supervisor and an assistant, which seems too less considering the client is a public interest entity. Yes, this is right. Part qualified supervisor. The supervisor is a part qualified means he has inadequate skills even though he has not studied AAA, SBR. How the hell he is appointed as a supervisor? And expertise needed to perform audit of a listed company, and this is evident from the inappropriate decision he took on cash settled share based payment, IFRS 2 accounting treatment and its materiality. Temporary assigned audit manager, Rodney. The temporary audit management has come too late when Rodney, the previous manager, has felt ill at the very start of audit. This demonstrate that the entire audit had been without a clear set of direction and supervision needed. Now, wrong instruction. Rodney, the previous manager, has provided a clear lack of direction at the start of audit when he instructed to use the prior year working papers. If the audit team is in any doubt, prior year audit working papers will not be appropriate in giving guidance to any new issue or areas for current year audit like cash settled share based payment. Now discuss the share based payment scheme. There are multiple issues related to share based payment scheme as follows. The share-based payment scheme was not identified as a risky area at the planning stage, brings into doubt the overall quality and competence of the audit planning and direction at the start of the audit. New events and transactions are considered as risky areas at planning stage, and thus the audit of Watson lack adequate planning. The audit supervisor has taken a wrong judgmental on the materiality of the share-based scheme by concluding it's immaterial, taking into account the quantitative materiality, that is 195,000, which is 0.36% of the profit and 0.84% of the total assets. However, the share appreciation rights were given to directors, which makes them material by nature. Remember, related party. qualitative, I have mentioned even the amount is zero, it will be material as always, irrespective of their amount. If you will cover both these aspects, qualitative as well as quantitative, then you will get 2 marks. Another issue with share-based payment scheme was that the audit supervisor demonstrated inappropriate professional behavior as he failed to identify that the accounting treatment adopted by the management for a cash settled share-based payment scheme is wrong, as the credit effect has been taken in equity. Now you got the thing. It's such cash settle share based means, and the management has taken it into equity means they put it into a reserve, which is a wrong statement, which overstate the equity component when it should have been taken in liability. This liability is understated and equity is overstated. Moreover, the fair value of the share options to recognize the expense and liability should be taken at year end rather than fair value taken at grant date was another issue where the supervisor went wrong with his decision making. Now, work of expert. There are multiple issues with the approach taken by the audit supervisor to rely on the work of an expert. Firstly, the supervisor just filled the expert report without carrying out any audit procedures on the expert report or in going through the assumptions used by expert. Secondly, the professional looking website itself can't justify the competence and experience of the valuer. Thus, inadequate evidence was gathered on the work of expert. Now we left with the last question, which is question 4, cow company. This is the easy question. I would like you to solve all these parts, even though I have written down the answer of the part C and D for your understanding. So take care and goodbye.